The following presentation is intended for financial advisors only. This event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of the investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance.
Greetings, I'm Mike Hurley, Chief Market Strategist for NexPoint, and welcome to our Market Minute for Monday, June 21st, 2021. Well, important last week were the comments that came out of the Federal Reserve Open Market Committee meeting, which were widely viewed to be hawkish, meaning in favor of higher interest rates and a tapering in their policy. That set off a series of dominoes, which is starting to affect the markets as follows. First of all, you can see in the bottom right pane that the US dollar bounced smartly off a very important area of support around 90. Higher dollar means weaker commodities, and you can see the Bloomberg Commodity Index pulled back from 95 to just under 91 as well. Higher dollar or a stronger dollar is usually bearish for emerging markets, and you can see the EEM ETF was also weak, putting a bit of cold water on that rally that had started a few weeks ago. And finally, it was a rough week for the markets Wednesday through Friday, and you can see even the Dow Jones Industrial broke a minor area of support around 33,500. We think, again, this is the first domino in the series, and we'll watch how this plays out in the weeks to come. Stepping back and looking at the big picture, you can see commodities have been strong for the past year as measured by, again, that Bloomberg Commodity Index going from 65 to 95. You can also see that as we're starting a larger consolidation or look to be starting a larger consolidation, it comes after a smart rally over the short term. And this bullish flag that we talked about several weeks ago worked just as advertised, meaning the leg out of the pattern or the formation was very similar to the one which led into it. With regard to larger consolidations, the 10-year Treasury has been forming a larger consolidation. Remember, it rallied from 0.5% up to 1 3/4. So naturally, a couple of months going sideways is not a problem at all. And again, it continues to look like a healthy consolidation for the 10-year Treasury. Finally, looking at stocks, we've got 4 charts for you: the S&P 500, the NASDAQ, the Dow Industrials again, and the Russell. The point being, we are still seeing a couple chinks in the armor. While the markets themselves have been strong and really gone straight up over the last 12 months, you're starting to see internals diverge on the NASDAQ, meaning the advanced decline line weaken. You're starting to see a fewer number or a lesser number of new 52-week highs. And you're also seeing, again, in addition to the Dow breaking a minor area of support, you can see that the Russell seems to have a failed breakout now compared to what we saw last week. I've been Mike Hurley, Chief Market Strategist with NexPoint, with our Market Minute for June 21st, 2021. Hope to see you again next week.